All right, the fourth and final statement that we're going to talk about is a statement of cash flows. So this statement is very important because it pretty much takes the cash account and it dissects it into more detail. So let's say hypothetically we have a cash beginning balance of 10,000 and an ending balance of cash of 15,000. We have a difference of $5,000. So this $5,000 is going to be further dissect within the statement of cash flows to figure out why that increased and how it increased. So essentially, it reports the effect on cash of the company's operating activities, investing activities, and financing activities. Every business in the world has D3 activities no matter what. So in general, it shows the net increase or decrease in cash for the period. So there's three types of business activities which all companies are involved in. Once again, operating, investing, and financing. Now we're diving into each one in more detail. So operating activities are those activities that have to do with the main day-to-day activities of the business. So I want you to picture this. In our water bottle business, where we produce water bottles and we sell it for a profit, we have to first go out and buy the actual raw materials. We have to buy the bottle caps, we have to buy the plastic, etc., etc. That's the day-to-day activities. Then we have to actually produce the water bottles, pay our employees, pay rent for the building we're situated in, etc., etc. Then we make the sale. So anything that has to do with revenues, expenses, and related accounts such as accounts receivable and accounts payable is going to be the day-to-day activities of the business. So essentially anything that's to do with accounts receivable, supplies, inventory, prepaid expenses, things such as accounts payable, salaries payable, interest payable, income tax payable under revenues is going to be our day-to-day business activities, and that's going to be our operating activities. Next one is going to be investing activities. So the goal is to earn positive cash flows from our operating activities so we could go in and take that money and invest into the future growth of the business. So this is the purchase or sale of long-lived assets needed to operate the company. So not just long-lived assets, essentially long-term assets, such as long-term investments, property, plant, and equipment, intangible assets, and goodwill. So examples include purchase or sale of long-lived assets such as property, plant, and equipment, and intangible assets. So let's just say now we take our money from our operating activities and we go out and buy a delivery van. A delivery van is a part of property, plant, and equipment. Now we're expanding our business. We're investing into the future growth of our business. Or the purchase or sale of investments such as shares or debt securities of other companies. So let's just say hypothetically we have cash laying around. Like, you know what? Let's buy the shares of Apple. So when we buy the shares of Apple, that's an investment for us because let's just say hypothetically we buy the shares of Apple for $10 and we're predicting in the future it's going to go up to $15. So we're predicting a $5 capital gain increase. So that's where we make money, correct? Or debt securities, we lend money out to a friend or another company for the purpose of us earning interest. And then we have financing activities. So financing activities is, remember, there's two ways a business could finance its operation. There's debt financing and there's equity financing. Debt financing is we go to the bank, we take out a loan, or equity financing is we issue shares to the public. And remember, under equity financing, we also have the the payment of dividends. Very key. So financing activities includes obtaining and repaying funds to finance operations of the business. So this includes selling or repurchasing shares. Remember, shares, we have preferred shares or we have common shares, which is part of shareholders' equity. Or we could borrow money or repay the actual loan. So let's just say hypothetically, we go to the bank, we take out a loan. So that's us borrowing money. Or let's say we have excess cash laying around, so we decide to pay down our loans. So remember, there's different forms of debt, which are bank indebtedness, bank loans, long-term debt such as mortgages, bonds, and finance leases. So next, we're going to do an actual example now. So once again, I want you to pause this video, get a piece of paper. I want you to kind of write out this example as I go through it so you can kind of start learning it. So once again, this has a three-part title. We have the company name, we have the statement name, and we have the date. As you can see, the date differs between the balance sheet and the statement of cash flow. So just a quick recap. We have 4 financial statements: income statement, statement of changes in equity, or the statement of retained earnings. We have the balance sheet, and then we have the statement of cash flows. The income statement, the statement of change in equity, or the retained earnings statement, and the statement of cash flows are for the month ended October 31st, 2018, or if you're doing for the full year, for the year ended, whereas the balance sheet is just at October 31st, 2018. That's very, very important. And you will see this as you look at examples of the financial statements. This is consistent. So essentially, the balance sheet is at that date, at October 31st, because at any given point of time, that's the actual balance on the balance sheet. Whereas for the income statement, the statement of changes in equity, and the statement of cash flows, every year those statements get reset and we have to redo them for that specific time period. So remember, 3-part title, and then we have operating activities, investing activities, and financing activities in that specific order. So we're going to do operating activities first. So they're saying cash receipts from operating activities. So cash receipts is cash inflow, cash coming into the business is positive 10,200. Then we have cash payments for operating activities, which is cash outflow, cash leaving the business, which is negative 8,300. So once again, we are doing a calculation. So we have 10,200 minus 8,300, the bracket. So in accounting, either we could have the negative sign or we could have brackets. It means the same thing. It means negative. So we're doing 10,200 plus negative 8,300 underline gives us 1,900. So they're saying that our total operating activities is 1,900, which is a good thing because we have cash coming in from our day-to-day business transactions. Then we're going out and we're purchasing equipment for $5,000. So we're reinvesting into the future growth of our business, which is a good thing. So this is net cash used by investing activities, negative 5,000. So over here, we have net cash provided by operating activities, 1,900. As you can see, this is provided by and used by. So provided by is when we have a positive cash flow overall, and used by is when we have a negative cash flow overall. Then we have financing activities. So we have the issuance of common shares of 10,000, borrowing of bank loan of 5,000, and the payment of dividends of negative 500. Dividends is financing activities because it has to do with the issuance or the repayment of common shares. It has to do with the financing of our operations. So in this case, we have all of these. We have 10,000 plus 5,000 plus negative 500. Underlined, once again, is 14,500. And we have net cash provided by financing activity. Since this is positive, this is provided by. Now we're going to add up our operating activities with our investing activities with our financing activities. So in your calculator, I want you to do 1,900 plus negative 5,000 plus 14,500 to get the total increase in cash of 11,400. So the beginning cash balance is 0 in this case because remember, this is the first year of operations. That means that the ending cash balance at October 31st is 11,400. So as you can see in our balance sheet, the balance of cash at October 31st is 11,400. So the statement of cash flows is pretty much taking the beginning cash balance, which is 0. It's 0 because this is the first year of operations for our business, and it's reconciling it to the ending balance. So we have a beginning cash balance of 0, ending cash balance of 11,400. We have an increase of 11,400. Now we know this increase is coming in the form of 1,900 operating, negative 5,000 investing, and positive 14,500 in financing. So what they're saying is we're earning, in the first month, we're earning pretty decent amount of money from operating activities. It's the first month of operations, 1,900 is great. So we're taking that and we're investing it into the future growth of the business by buying equipment. However, we don't have enough money. So we're going out and we're issuing common shares to bring in cash. And we're also borrowing money from the bank as well to bring in cash. So now we have cash flow. So we're borrowing 14,500 in total, which is normal for a business that's starting off. So that's actually a good sign, correct? So this over here is a statement of cash flows. It's a great statement to learn.